Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tuesday Tech Talk for Tuesday, August 7th. My name is Will Pauly and I'm here with my co-host, David Blake. David, how are you doing?
I'm good, Will. How are you?
I'm doing all right. Let's get started with the market letter. David, can you give us a quick rundown of what's been happening this past week?
Sure. Last week we had the S&P 500 and the Dow Jones making 5 in a row. The NASDAQ and the Russell 2000 were both up also. They snapped a 2-week losing streak where we've been talking about the last couple of weeks where we had the negative divergence showing up in those indexes and had a little bit of a worry where we thought we might be getting ourselves set up for a little bit of a pullback. Anyway, we had a little bit of the trade talks subside a little bit. The investors are focused more back on earnings, according to FactSet as of a week ago, with about more than 53% of the companies reporting second quarter earnings. We're having about 83% of the S&P 500 companies reporting a positive earnings per share surprise, and 77% are beating sales expectations. So earnings still are fueling this market to what I think is going to be a run to new highs here, maybe even this week. We had a nice little pop again today, but we're still just a little bit shy of all-time highs. Technical condition of the market remained mixed last week, but again, the Dow Jones and S&P were able to string together a 5th consecutive winning week. Momentum is remaining positive for most of the different indexes. It has slowed somewhat, especially in the case of the small caps. The Russell 2000 barely stayed above its 50-day moving average to end the week, but with 2 positive days so far this week, that moving average has been taken care of again. A lot of the negative divergence that we looked at over the last couple of weeks in the charts is starting to work its way out, where we're looking at where the market probably is picking up a little bit more momentum. Part of that is partially due to the trade talks backing off a little bit. Also, we're seeing a little bit of that rotation that we talked about out of some of the high-flying tech talks to a little bit more conservative investments. And by that I mean consumer staples. The REITs were looking good. Healthcare is having a breakout. Even industrials are breaking out. And today we're having a nice move in the financials, and they are breaking out too to the upside. So looks like we're regaining some momentum that's going to take the market to new highs. Another part of the negative divergence that we looked at was in the new highs and new lows. And we're going to take a look at the market recap a little bit later to take a look at that. But again, the market's starting to improve a little bit this week as we go on, and I think that we should be able to reach new highs in either probably in the S&P 500 later on this week.
All right, thanks, David. So there's a lot of information in this market recap that we've been talking about. I was hoping you could explain to our subscribers how they could get more value out of these charts.
Yeah, let's go back to the home page here a minute. Okay, on the home page over under these market indicators, you'll see up here we have the S&P oscillator, which is updated nightly. We'll alert you whether the market's overbought or oversold. Right now it's good shape. 2.4, usually over about 4 is where we start getting a little antsy, where it gets a little bit overbought. We're not there yet. This will probably move up today. CTI is still a bullish +2. The market posture is bullish. And we talked last week that we thought we might be going to neutral or a sell possibly by this Friday. That's still going to be we're still going to have to wait and see on that, because we also have the Dow Jones Transportation Index joining the Dow and breaking out to new highs since January. So I think one of the counts on the CTI thing leaves it bullish for a little while longer, and I would not be anxious to be selling off the market quite yet. But anyway, as you go under here and you see these bright lines over here, you're going to come to the market recap. Just click on that. And what you're going to get the major averages, which is a quick chart, a bar chart with the 50-day moving average. So you can see all the moving averages are well above that, even over here on the Russell 2000, which we just talked about. We have Monday and Tuesday where we've climbed back up. There's a big resistance on the Russell 2000 here at 1700. We got up to about 1695, I think, today. I would expect to see that break through that, but break above 1710 is going to be very bullish for the broader market. Again, over here you can see the transports breaking out to their highest level since probably January, February. Utilities still looking strong, so everything's still looking good. The negative divergence, like I said, that we were seeing is starting to dissipate a little bit, and I think that's a good sign for the broader market going forward. At the bottom of this market recap, we have some other charts that I talk about when I talk about the health of the broader market. And in this case, the top two here, first of all, is the NYSE advanced decline line and the NASDAQ advanced decline line. Okay, now what these are going to do, these lines subtract the number of declining issues from the number of advancing issues, and it becomes like a cumulative total, and it can tell technicians how many stocks are participating in the market move. Okay, when the advancing issues greatly outnumber the declining issues, the uptrend is said to be strong, like through here. Okay, over here you can see it's a little less strong, but we're starting to break out to the high side again. And what this means is the majority of the stocks are heading higher, and the market should follow this line. We consider these AD lines as leading indicators of market direction. Okay, I know Martin Pring in his book Technical Analysis explains that when the AD line rises in concert with the Dow, it's telling us the rally's in good health because there's widespread sponsorship by market participants. However, at some point in the bull market, the AD line will peak out while the major averages continue to rally. This is known as negative divergence, which we talked about over in here and over here with the NASDAQ, and that has traditionally warned of trouble. Okay, well now starting this week, we're starting to get a broader participation in this market again, and that's probably means that's one of the signals that's telling me that we're probably going to advance to new highs here. Okay, it's mandatory to wait to some kind of trend reversal signal in the averages as confirmation before concluding the average will decline. Like just because the AD line here starts to go down, you want to have confirmation from that by either maybe let's say MACD will start to roll over, or maybe RSI begins to trend lower too. So the NYSE AD line made a new all-time high Friday, made one yesterday, and it'll also make a new one today. So this is pretty much telling me that we're going to continue to advance a little higher unless we get some kind of crazy tweets from the president or something like that. Okay, another useful indicator that I look at down here is the NYSE and NASDAQ new high, new lows. Okay, again, we showed this over the last couple of weeks, and here we talked a little bit more about the negative divergence that we would see. Okay, the market's hitting new highs. You want to see a greater number of stocks making new highs, like this. This was pretty strong back in June. We had a pretty good move here with the NASDAQ. Over here, it's preferably like to see up around over 200, maybe 250. Today, market, we're up again about 150 points in the Dow, and we have triple-digit new highs on the NASDAQ and the NYSE, which again, it's alleviating some of that negative divergence that we've been looking at over the last couple of weeks. It had me worried that I thought we were going to see a pullback in the market. So this is looking healthier. Negative divergence needs to be going away. Good participation for new highs today, triple digits in both of them, and that's what we want to see if this market's going to head out to new highs. Now, just below that, you can look over here. We have a bad data point over here, which will be taken out of here and put in. But this is the put-call ratio, and this is more of a sentiment indicator, along with the VIX and also the weekly bull and bear advisors. On the put-call ratio, what this does, this reflects a 5-day moving average of the number of CBOE, total calls and put options that are in the market. If you get a ratio greater than 1.70, which means there's 170 puts for every 100 calls. That's actually bullish, which means market participants are getting a little bit too bearish on the market. When they get bearish and they get scared, it's usually a time when the market is usually coming close to a bottom. Now, if we get between 1 and 1.69, That's pretty much a neutral reading. We get below 0.99, since most money managers and portfolio managers need to hedge some of their portfolios. You'll always have some puts being bought. But if it gets to the point where we break below 1, that starts to be more of a bearish sentiment indicator, which you want to watch. Right now, we've been going along here pretty much with around 0.95, 0.98. So we are seeing a little bit too much call action right now, which you want to kind of keep an eye on. But it's not getting overly heated up. Now, these things really are best used for sentiment indicators when you see a large move one way or the other. Like they're going to fluctuate a lot, but when you see the spike up to, like, say 1.8 or even 2.0, then you know that you're probably at a near-term top or bottom. Okay, now let's over here, the VIX. Now the VIX, which they call the fear index, this kind of lets you know what traders are thinking about, how nervous they are about the move in the market. We're down here today right at 11, which is, again, a little bit, means that we're getting a little bit too complacent with the market, but the market doesn't see, as far as the economic data that's coming in, the earnings that are coming in, they don't see a lot of reasons why this market should be pulling back, except for the fact, except for the trade tariffs that we're seeing. So they're getting, the longer the trade talks linger, they seem to be getting more comfortable with the fact that the trade wars are here for a little bit longer, and they're pretty comfortable with this move in the market right now. Okay, another sentiment indicator is the weekly bullish and bearish investment advisors, and these are the newsletters that will measure how bullish a newsletter writer is or how bearish they are. With these, what we generally have is on the bullish writers, 0 to 40 is very bullish, 40 to 54.9 is neutral, and when they get too bearish and this little line gets above 55, that's usually a sign that we may be getting near a top. And you'll see this up, I think in January we were up in the 60s, somewhere like that. Now, one of the reasons this is also a contrarian indicator, because if all the advisors are all bullish, that means they're all in. So where's the money coming from that's going to propel the market higher? It's not going to come from mom and pop. When they get too bearish, that means they're out of the market. And that means that we're probably near a bottom, because they're going to have to buy to go back in. Now, as far as that goes, what you look at on the bearish advisors, okay, when you get down here below 25, where we don't have any bearish advisors, that's also a warning sign. We're not back here where we were back in March, where we were all the way down to the 14 and 15. You'd have a bear on the street. That's not a good sign. That's usually a sign that you're probably going to get a little bit of a pullback. So again, when these get to extreme levels, that's what you want to look at as far as what may what the sentiment is like for the broader market. Now, if you go down here a little bit more, two other ones we put in here. This is the equity mutual fund flow. That's money going in or out of the market. We had the zero line here. We actually back here in June, while the market was rallying for the summer rally that we've had, the money was coming out of the market. Again, kind of a contrarian market. You have too much. If people are starting to get a little bit worried, they start pulling money out. That could be meaning that that we're getting nearing a bottom and the market could work its way higher. On the other side here, you have margin debt. Again, this is how comfortable are people borrowing money to get in the market. Now, when this gets too high, and right now we're at pretty much a record high, which is a little bit of a flag. But when investors are borrowing money like crazy to get into this market, that can be a red flag to you. It means sentiment is a little bit too bullish. So we are having a little bit of that going on right now. Another sign that we're probably going to see a little bit too much bullishness is if we make a new high this week. Expect to see the newspapers start to hit the headlines that the S&P at record high. That usually will get people shook up a little bit, and you'll see more of the mom and pop start to move back into the market.
All right, thanks, David. Now that we've got an idea of how these market recap charts are moving and how the broader market is looking, let's discuss a question that was sent in to me earlier this week. So this question is from one of our subscribers. He says, so the CTI is scheduled to go bearish on August 10th. How long is that expected? Can I schedule my vacation around it?
Okay, I'm looking at it right now. The CTI could go to a bearish account this weekend on Friday, but I have two different scenarios going right now. This isn't an exact science. Currently, with the negative divergence working its way out, one of the accounts that I've been on for most of the year will continue to be bullish for another week or two, maybe even 3 weeks, or neutral. And it kind of the reason we don't just go in and out of the market based on the CTI is we look at the momentum indicator that's in the market letter and also the sentiment indicator. If the CTI gets to where we're looking where it could be either neutral or bearish, but we're seeing a pickup in the momentum, we can expand the cycle out. That means the CTI would remain bullish for a while. You'll need to take a look at Friday's market letter to see what we do, right? But at this stage, like I said, I expect the momentum is still strong right now. It actually went up a couple notches last week as the week ended, and I would expect to see us at least probably for another week or two remain bullish, and then we can then if the market begins to show more negative divergence, then it'll probably roll over that way. But I think the cycles will be extended probably another week or two.
All right, well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.